Great.
Well, good evening, everyone, and welcome back. This is our third session in this course, the coming 2026 financial and economic crisis. And I thank you for coming back to join me in this discussion. As usual, if you have any questions or comments, use the reaction function and raise that yellow hand. And I will also be asking for a volunteer to help me as a reader again tonight for anything that's quoted on the screen. So where did we leave off last week? Well, I basically gave you a little bit of an economics lesson on the supply-demand curves and highlighted the idea that the problem with the idea of general equilibrium or equilibrium between supply and demand in microeconomics doesn't work very well for land because of speculation. So that in the absence of a significant annual tax or charge on land holdings, the supply curve for land will lead to the left. And that's an indication that land is in a very good asset to hold for speculation. The prices will tend to increase much faster over time than in other assets, and it's a secure asset because it doesn't depreciate. So that's a little bit of where we're going to lead from. Here's just an image I found on the internet that I thought was kind of interesting, just to show the early stages of economic development and beginnings of the factory system out of the guilds. So political economists and economic historians, economists, and even many non-specialists have been analyzing the causes of financial and economic crises that have occurred from the very beginning of this shift from feudal craft guilds to market-driven production and commerce. And that process has been undertaken, of course, by varied types of ownership, sole proprietorships, partnerships, corporations, and even cooperative enterprises. And their findings, what all of these analysts found in their studies, is really worth examining in some detail. And you have to go back and study the historical record and what they wrote. So you have the writings of mercantilists, of the French school known as physiocrats, of the English classical school, and then subsequent generations of analysts that each offer insights into the causes of systemic instability. And they offered what they thought were practical solutions to this instability based on their own understanding of history and, in a sense, often influenced by their own ideology and biases. So it's hard in political economy and studying social organizations for people to sort of step out of the place that they play in society and be totally objective. Some are more objective than others in what they come to. Here's an image of generally what is described in most textbooks as the business cycle. And it just shows the modern understanding of each phase. So as long ago as the 17th century, the cycles were both observable and measurable. The statistics we capture today, they really ought to provide a strong ability to determine where we are in the cycle and forecast what is coming over the horizon. However, for many reasons, this has proven to be elusive. So the question arises, what variables can we identify that contribute to the depth and duration of each phase of the cycle? And let me just put that question to you. Everyone here has lived through at least a couple of these economic cycles. You've been employed, maybe you've been unemployed, maybe you've had to cut back in your business activity, your investment activity during the recessionary downturn. So what do you think are some of the major issues that contribute to the depth and duration of each phase of the cycle? Any thoughts? too early in the lecture. All right. Well, just keep that in mind, because there's individual actions, there's collective actions, there's societal actions, all of which are going to determine to some extent the depth and duration of each phase of the cycle. When we're at the bottom of the depression, when unemployment is at its maximum, what should people be doing? What are people doing? What are businesses doing with unsold inventory, for example? Are they letting workers go because they don't have any demand? And what happens to those workers? There are famous stories, in the United States during serious recessions, not even depressions, where the factories lay off workers. And then when things start to pick up, well, now you have to go find them again. And maybe you have to retrain them because they've been off work for 6 months. It's not so easy. So what is the best strategy for a business? Is it to reduce the working hours of all employees, but not lay off anyone? Or, when you have unions involved, you might have the union regulations that suggest that the last hired is the first fired. All of that independent of their ability to contribute to the business activity. And then there's government. You're trying to decide what measures to take. So all of that is coming into play. And yet I'm arguing in this series of lectures that there is still sufficient consistency that this cycle repeats. And it is repeating right now, and it will reach the point of maximum stress at or around 2026. Now, here's a chart that's telling you what the annual gross domestic product and real GDP is in the United States for these years. And so they're tracking reasonably close. So adjusted for whatever adjustments are made to the gross domestic product to get to real GDP, it's important, but they've tracked fairly close. Now, as real GDP has been measured, the US economy technically recovered in 2021 from the COVID-19 pandemic. It showed a 5.7% increase over 2020. And as I explained earlier, what this simple measure doesn't reveal is whether the spending improved the quality of life for most people in the United States, or simply reflected the huge increases in spending on the military, on disaster relief, and on the distributions of money to keep the economy from stalling. So just once again, always be skeptical that when you hear GDP figures, that you're really getting a clear indication of whether things are getting better. Also ignored is whether the increased spending by government was paid for from revenue taken in from taxation and fees, from the issuance and sale of bonds, then whether those bonds were held as assets by the Federal Reserve System, or those bonds were sold to investors, or whether by straightforward monetary expansion. This mix of how revenue is raised constantly changes, and it changes the ability of government and the central bank to then use their powers to achieve a sustainable, non-inflationary economic climate. And those who hold government positions and are on the board of the Federal Reserve, they're getting advice from all parts of our society. And what advice they should take is right now in a great deal of dispute. There is an intensifying debate that's arisen over whether a country such as the United States, which is a sovereign currency issuer, needs to be at all concerned about the level of bonds held by individuals or private entities or the central banks of other nations or even other governments. And the debate centers around what is referred to as modern monetary theory, or MMT. For those of you who are familiar with the Henry George School's programs, we've had discussions about MMT, and I'm just going to give you a brief summary of what the main arguments are that are being made by MMT's primary public face, and that's Stony Brook University economics professor Stephanie Kelton. She's one of a growing number of analysts who argue against conventional economic wisdom where government budgets and spending are concerned. And in her book, The Deficit Myth, which is published in 2020, she lists the 6 myths her book exposes. First is the myth that the federal government should budget like a household. Okay. She challenges the notion, excuse me. I didn't think my throat was going to bother me tonight. But this looks like a long-term issue I'm dealing with. Anyway, she challenges the notion that revenue should be raised prior to any expenditure, or that the federal government borrow only as absolutely necessary in response to short-term and unanticipated revenue needs. The second myth is the myth that deficits are evidence of overspending. And here she argues that most of the time deficits are actually too small, not too big. Only when inflation occurs is this evidence of overspending. She is confident that monetary expansion can be so managed that inflation will be modest. Now, to the extent that I've studied Stephanie's writings, I have not found that she fully appreciates the power of property markets and the increase in property and essentially land prices as a primary driver of inflation. Maybe she does, but I haven't discovered that in her writings as yet. The third myth she points to is the myth that deficits will burden the next generation or future generations. She presents data indicating that deficit spending has constantly led to higher standard of living without necessitating higher taxes. Different economists are going to argue over the statistics, but we've had periods of pretty high debt in the United States since the end of the Second World War. And yet, up until the late 70s, anyway, according to the genuine progress indicator, the standard of living for most Americans had continued to increase. We'll be discussing what happened in the late 1970s in more thorough detail later. Fourth is that government borrowing crowds out private investment and therefore short circuits long-term economic growth. Instead, she argues that government deficits act to increase private income generated by savings, and this increased income is then available for private investment. So you have to think about that. What do individuals do with their savings? You can invest it in a stock market, you can invest it in government securities, and the interest income that you earn on bonds or any fixed income asset, it can be reinvested as she suggests. Whether or not money invested in the stock market results in an increased investment by corporate entities in expansion of their businesses and new infrastructure and all that is also subject to a lot of debate, as we all already know, as what happened after 2008 and the bailout. The money went to buy back stock and to pay corporate executives exorbitant compensation. So what's the fifth myth? Fifth is the myth that deficits make the United States dependent on foreigners who then gain leverage over us. She urges us to look at what actually occurs. Foreigners accept US dollars as payment for goods and services. They can either hold the cash in reserve, they can invest in US government securities, or use the dollars to make purchases of US produced goods or services, purchases of shares in US corporations, or purchases of natural assets. So you have to take a look at, for example, back in the 90s, I did an analysis of the Saudi Arabian economy and its overseas investments. and they were heavily invested in many countries, in real estate and in corporate stocks. They wanted to make sure that if the price of fossil fuels dropped, that they would have alternative investments yielding income for them. So, I mean, that's a natural strategy. The Chinese, the Japanese, all countries that receive a huge amount of US dollars have to engage in. They're not going to just sit on those dollars and not earn anything on them. The sixth myth, she says, is the myth that entitlements are propelling us toward a long-term financial crisis. Instead, she says the US government will always be able to meet future obligations because it can never run out of money. Our money is a fiat currency, not backed by gold, by silver, or any specific tangible good. I often describe the Federal Reserve note as a promise to pay nothing in particular, because what a $1 note will purchase today may be quite different from what it'll purchase tomorrow or the day after. You might be able to get more tomorrow, less the day after, more the day after that. It's an interesting level of confidence we have, but we must accept this currency in exchange because it's legal tender. But there's no guarantee on what it will purchase in exchange for your labor or for goods that you sell. So basically, that's what MMT argues, what Stephanie Kelton argues, are the myths that exist about our current policy. I'm willing to take a minute or two now to get your reactions. Some of you may be strongly supportive what MMT argues, and some against. So does anyone have anything you'd like to particularly share? Joe.
That's a good summary of Kelton's positions, which I quite agree with. I think I would like to add, though, that basically that's Keynes. All those positions, I think, basically you can find in Keynes. And there's another fellow I'll just
including an absence of appreciation for the power of property markets.
Good point. Another fellow that has a similar set of positions, in fact, she's highlighted him once, is a fellow by the name of Frank Newman. And he was the deputy treasury, deputy whatever of the Treasury. And he was the CFO of Bank of America and Wells Fargo at different times. So he is a very knowledgeable, experienced individual. And he wrote a book called The Six Myths, interestingly enough, which hold America back. It's a little different, but not that much. And he goes, the title includes a comment about China, why China is not being held back, what we can learn from China. And in other words, China doesn't kind of get fooled by these myths. I would say in particular, the household fallacy and the paradox of thrift. And in the book, I'll just mention one other book by Mervyn King, the former governor of the Bank of England. He wrote a book called The End of Alchemy, which referring to money.
Yeah. King is often quoted as the whistleblower on the role of banks in creating money with each new loan that is made.
Right.
And boy, it took me a long time to get my head around the idea that my own banking experience involved creating new money out of thin air.
Well, that again, Keynes said that a long time ago, as did others. It's a very old, that was pretty popular commentary in the 30s, right? So there's nothing new about MMT. They have some what I would call quirky or eccentric.
Yeah, there's also it's interesting, Joe, because you never hear any discussion of Stephanie's work or MMT in the mainstream media. I mean, I would expect it to creep into NPR or Vice News or John Oliver, but so far it's remained as a very marginalized view, and I wonder what it's going to take to raise the level of discourse so that these ideas become part of the higher level discussion when it comes to policy making, what it's going to take. And
Well,
I fear what it's going to take is the 2026 crash.
Well, the COVID kind of proved the point. The amount of money spent by all the major countries, financed mostly by central banks, kind of proved the point, but it's being ignored. But
Well, it proved the point, but every government is trying to put the genie back in the bottle.
Right.
I mean, with laws that, we're going to do more for our people, but we're going to do it while we pay down the debt.
Yes, we're going to fix the central bank's balance sheets. But the other thing I would point out, there's a Canadian economist, Mark Lavoie, who wrote a paper. He's pretty friendly to MMT, or the basic thinking that you've described. But he had a really good working relationship with Godley. I can't remember his first name, who was a highly respected economist as well. And he wrote a paper called A Friendly Critique. And basically what he's critiquing is the fact that MMT has this kind of this eccentric way of saying things, which are kind of showstoppers, confuse people, confuse other economists, and create great debates about these little minutia things. And I think that applies to what the question you just asked. Like, they could have expressed these things in a much more conventional way. And, but it probably relates to Mosler, I think, who has, I think he's a very clever man, but he does have an eccentric way of talking about things. And
well, your comments, I want to move on, but your comments simply highlight the importance of for everyone to at least familiarize yourself with what Stephanie Kelton and the other MMT analysts have to say. You may not totally agree with that analysis, but it should be part of the discourse. And so I thank you for adding those comments.
Thank you. And I'll put Newman in the chat. Okay,
I appreciate that. I've written it down, so I will try to take a look at what he has to say as well. What I'm getting to is that while it's certainly the case that the US government can never run out of money, this doesn't reduce what should be of highest concern, which is finally creating a system of public revenue that charges individuals and private entities based on the value of benefits received. This is not what we have now. We have a hodgepodge system of public revenue that is really not based on economic science, and not even based on morality or ethics. It seems to be based on what the public is willing to bear. And over the decades, it's been nuanced in that way, and we get used to it. We get used to being taxed and required to make certain accommodations. And we do it oftentimes not very happily, but not resisting in an organized way. And those organizations, those individuals that do organize and resist, tend to have a very narrow focus that does not necessarily look at benefits received as the basis for what individuals should contribute to the public purse. And so that's what I think we need to get to if we're going to be able to tame the economic cycle. So by this criteria of benefits received, rents of land of all natural resources and what I call competition limiting licenses. For example, licenses that restrict individuals from taking fish stocks out of the ocean, or licenses that limit the number of bars that can exist in a neighborhood, or the number of taxi cabs that can be on a street in a city. All of those licenses are competition limiting, and they tend to have a secondary market value. So while they're not, the charge to the initial recipient might be nominal, the value of that competition limiting license over time can have a very high value because of its monopolistic characteristics. So rents from land, from all natural assets, and from these licenses, I argue, as Henry George would have argued, rightfully belong to the community and by definition are non-tax revenue. In other words, we might collect it via taxation, but if one defines a tax as a confiscation of private income or private property, then the collection of rents is not a tax. It is a charge for benefits received. So taking that one step further is the failure to fully collect these rents. That is a fundamental injustice. And that injustice threatens not only our democracy by the transfer of wealth and income from producers to the beneficiaries of rentier privilege, who offer really nothing in exchange for the wealth that they extract from others, but it also threatens economic stability. And that's a major distinction that is not being made by mainstream economists or in the media or by our politicians. I don't know how to get that message across to them, but I think it's an important one that needs to be developed in order to have the right discussion at the policy level. And of course, during the 19th century, it was the American political economist Henry George, studying the history of cycles of boom and bust. He reached conclusions based on the evidence others had either downplayed or ignored. It was George who observed that the underlying cause of these problems is the speculation-driven rise in the rental value of natural assets, that is, of land in all its forms. And that rent remaining in private hands is capitalized by market forces into higher and higher prices that eventually cannot be sustained by the productive sectors of a society. Eventually, as those rents are capitalized into higher asking prices, the economy is going to reach a level of stress where the bubble is going to burst. And if you look closely at what is happening just prior to almost every serious economic contraction, and what you see building is asset bubbles in land and other natural assets, in real estate, in commodities, and in financial instruments. These conditions have been in evidence in the United States almost from the moment of its creation. Property markets have always been extremely important as a driver of the economy. If you go back to the founding generation, every one of the founding fathers and many British investors invested in US land, in the frontier, in the cities, with the expectation that they were going to buy cheap and sell at higher prices as settlers moved into the frontier and as businesses followed them. And that process has been going on in every country ever since. There have been severe economic contractions whenever the stress of asset prices brought the economy to this breaking point. This was certainly the case during the 1920s in the United States and in other countries, although it was a time of what we would think of as prosperity. This was apparent prosperity, but it wasn't very deep prosperity. In the United States, there was a growing middle class, an improved working class, but an enormous amount of poverty existed. And for a high percentage of the population, there was no increase in income or savings or net worth derived during the Roaring '20s here. The economist John Kenneth Galbraith wrote pretty extensively on the cause of boom to bust cycles. And he was troubled because of what economists accepted as conventional wisdom in the 1920s. Most economists believed, he said, and I'll ask if anyone would be like to volunteer to be my reader today. Some brave soul out there.
All right, I'll volunteer.
Boy, that was a reluctant, but
Yeah.
I thank you.
Yeah, that's all right.
Galbraith wrote
that economic life is governed by an inevitable rhythm that after a certain time, prosperity destroys itself and depression corrects itself.
yeah. So almost all economists in the early 20th century believed that cycles were inevitable. What troubled Galbraith, who believed in economic planning as a way to achieve stable economic growth, was that even by the 1950s, there were still many prominent economists who continued to hold the same old views, that only a recession and deflation could cleanse the economy of speculation. And as Galbraith looked at the conditions in the 1920s, he pointed to the amount of wealth concentration that existed in 1929 as a major contributing stress to the cause of the Great Depression. He wrote as follows.
The proportion of personal income received in the form of interest, dividends, and rent, the income, broadly speaking, of the well-to-do was about twice as great as in the years following the Second World War.
So, what he goes on to write and talk about is the Second World War brought economic policy making and planning into the mainstream. And it was by that involvement that led to laws during and after the war that prevented until the advent of the Reagan era in the United States, the Thatcher era in Britain, this beginning renewed concentration of income and wealth, and all of the changes in law and policy that contributed to that it continues to exist to today. Michael, I see your hand up.
Yes, I mean, as the evening goes on, I'm going back to one of the first thoughts I had when we started this evening about the business cycle. And what I wrote down, I draw your business cycle, that the peak down to depression and then up again. And it just struck me that these two extremes manifest because there is a great reluctance to accept change. And therefore you get the point where society changes, but people want to think it can go on forever, as it were. But there's a reluctance for that there's an inevitability that status quo cannot perpetuate because times have changed. And therefore it tips down to another extreme, which becomes intolerable, but the inevitable difficulty in getting back up again is because of this reluctance to change. An example is that perhaps you get in society, someone's someone's a carpenter or something, and then the way of producing things has to change because of new ways of working. But there's a reluctance, and therefore, there's a great difference in the reward that can be expected. But there's a reluctance to want to change, and the tensions and stress that we keep referring to occurs because of this. Our dogma. We hold on to things too long, and society cannot tolerate that because times have ever changed. They've changed.
Well, times do change, and generation. I mean, there's change going on all the time between generations, even in the same family. In my extended family, my father was a high school graduate. My mother went to a trade school. My brother and I attended college. I'm the only one who finished and went on to graduate school. And I have cousins who are professionals, and I have cousins who stayed in the same construction trades that was followed by my father and my uncles. That generation, they all followed in the footsteps of their father, who was in the construction trades. But our generation had a lot of more opportunity for higher education. And I suspect certainly in Britain after the Second World War, that would have been the case, and in many other countries. When survivors of the war came back to the United States from the military, they were given an opportunity under what was called the GI Bill of Rights to attend college or trade school. They were given an opportunity for advantageous terms to purchase a home. So there was a lot of change systemically, and individuals were changing too. Their aspirations were changing. I mean, genetics is part of it. I'm right now reading a new book by our colleague Heather Remoff, titled "What Sex Got to Do with It," and she's examining the Darwinian theory of natural selection versus what she calls sexual selection, and why, how powerful the selection of women for a male partner is in producing offspring with different characteristics or desired characteristics. So there's a lot going on here that I don't pretend to understand. The human nature is complex, and in every society we have groups of people who are type A personalities or type B personalities, introverts, extroverts, people who have bright ideas all the time, and other people who would like to see nothing but the status quo. Don't give me any challenges. I like the way things are. It's safe and secure. New ideas can create insecurity. So all this to me is going on at the same time within this construct of systemic foundations that cause this boom to bust cycle to repeat and repeat and repeat. Not exactly the same every time, but with many of the same outcomes based on the strength of the inputs that are occurring and the stresses that are occurring when the cycle reaches its peak. Mm. And what Galbraith was telling us is that, and he's not the only one, others pointed out too, that in the United States anyway, the concentration of income and wealth in 1929 did not become the same until 2007. And so we had a crash in 1930, we had a crash in 2008. And so there is a correlation. There has to be a strong correlation between that level of concentration and the strength it places on a society.
No, I agree with that. Perhaps I didn't describe it too well, but we in London are going to have a rail strike tomorrow, Thursday and Saturday, because of the in transients of perhaps the railwaymen, you know, they want a change of conditions. They want more wages, and there's a reluctance to give that, because unless there's technological changes to justify it. And it's this situation that keeps occurring periodically. Perhaps it is every 18 years or thereabouts. You know, there is this reluctance to change, etc., to accept that things are not the same, and therefore we all have to, you know, readjust.
Well, do any others on the call tonight have a similar opinion to Michael, or do you see things a little bit differently?
Can I just add that that applies to all sorts of paradigm shifts, like George's land tax notions and monetary reform?
Oh, sure. I mean, look, I've been trying to convince my mayor in my little town the virtues of moving to a land-only property tax base. And she's basically pushed me off to her staff. And this is it's just very difficult to get people to think of the planet as our commons, and that if you live in a society where for generations land has been private property, and the sanctity of private property is challenged, common sense, logic, and facts don't often carry the day. I think it's one reason why, for the most part, not 100%, but for the most part, where the adoption of land value taxation has, at least in part, been successful, has been when the communities face disaster financially, when everything else they've tried has failed. And now they're left with few, if any, options. Well, we tried everything else and it's not worked. I'm not sure this will work, but let's try it. I don't know what that says about us as intelligence, as an intelligent species, but I highly recommend Heather's book for those of you who want to get into how we think and why we think. I'm learning a lot by reading it. Now, getting back to Galbraith, I'd add that I think there's a deeper analysis that's needed to determine to what extent interest and dividends accrued from reinvested privately appropriated rent. I mean, think about that. Those who derive a huge amount of income from charging rent to tenants or have that surplus income to reinvest. And so that comes back into the economy, and it can come back in the economy in a productive way or non-productive, you know, based on how those individuals choose to invest their surplus income. And we don't have good statistics on how rent derived. We don't have good statistics on the extent to which income is rent derived. And we don't then have any statistics that I can find to show how that rent derived income is reinvested. There's anecdotal information that suggests it's mostly going into the stock market because it's such a level of surplus income that people don't need it for their normal consumption. I mean, how many mansions can a very wealthy individual, even an oligarch from Russia, have? How many yachts? So part of the analysis of what kind of reforms would work are going to require we have more data, more statistics to show how much income is really rent derived versus earned, and therefore how it might be able to be publicly captured via taxation. So I just wanted to show, you know, in 1920s, here's just a broad picture of society. You know, you have people working in a kitchen, you have them working in an automobile factory, or you have them working on Wall Street or in the banking community. Some people were doing quite well, and other people as always, are barely getting by. Now, before we move on, I'd like to examine the conditions that existed in the 1920s more closely to see if Henry George and other like-minded analysts who made the connection between the monopolization of nature and nature's rents and these economic cycles of boom and bust are valid. And the 1920s is a story that is a time that has a lot of valid stories if we just look closely. There were the Florida land boom, well, the Florida land boom in the 20s, which is a poster child of how markets operating under long established but dysfunctional rules left to themselves will eventually implode. So you have a period of heavy speculation in oceanfront lots that was raging along the Florida coast. And then in 1926 and 1928, these new communities were hit with really serious hurricanes that nearly destroyed all of the new construction and flooded the whole area. So you had all these highly leveraged investors who were basically buying deeds to lots or options for lots on the ocean without seeing them, and then looking to flip them to others at a gain. So a lot of that kind of speculation occurred. When the hurricanes hit, investors that are holding these options and having to pay for them, and they borrowed the money from the banks, they could no longer find anxious northern buyers. And so they're blindsided by crashing land prices. Many defaulted, and this caused thousands of personal bankruptcies and led to many bank failures. So it's several years before the stock market crash when many banks throughout the country begin to become insolvent and are closed. The one writer who I would recommend that you look at as books, who dealt with this period in great detail, his name was Frederick Lewis Allen. And he wrote a book published in 1932 titled Only Yesterday. And in that book, he provides the details of how the dominoes fell during this period. And here's what he had to say. Go ahead.
Oh, sorry. In the autumn of 1925, the Florida boom was at its height. Men and women were exposed to the most delirious fever of real estate speculation, which had attacked the United States in 90 years. The Florida boom, in fact, was only one, and by all odds, the most spectacular of a series of land and building booms during the post-war decade, each of which had its marked effect upon the national economy and the national life.
Yeah, Florida wasn't the only one. There were land booms in almost every city across the nation. This was a period of intense speculation. The banks were very willing to provide the funds because they anticipated that the value of the collateral, the land and other real estate was going to continue to climb. In the book, Allen goes on to explain how the agricultural boom during the First World War triggered this intense land speculation as farmers were encouraged to borrow to add acreage under cultivation. The need then was significant as, of course, farmers across the European continent were prevented from planting and harvesting their crops. So during the 20s, things started to change. World War I ended. Farmers were able to get out and start clearing their fields of unexploded ordnance, replant. And when the harvest came in, the American farmers and farmers in some other countries that had no military conflict, they're sitting there with all this excess production And so what's going to happen when supply increases and demand is stabilized? Well, the prices of those goods are going to go down. So when the First World War ended, here's a chart that shows you a little bit of what was going on. Prices for farm products began to fall. And the US farmers began to really suffer because of this surplus of wheat, which had been heavily subsidized during the war. And then immediately after, the government basically propped up the price when they should have, started to ease back so that farmers could adjust. But this just gives you an indication of what happened to those prices from the end of the First World War all the way down until the Second World War started. So agricultural commodity prices are falling during that whole period until the war again returns to the same conditions, where countries that are in combat, they're not able to plant and harvest crops, and so they're dependent on imports, and prices are climbing up again and again. We're experiencing that right now, are we not? No one thought ahead about the intense dependency that Europe and Turkey and other countries might have on Ukrainian wheat or other crops that are being grown that are not being available for export, including those from Russia. Well, the export, this is a picture I found of a banker sitting there with a farmer going over his financials. And you can see that the look on the farmer's face isn't too good, and the banker isn't too pleased either with what he's looking at. So the export subsidies were finally eliminated in mid-1920. And at the time, the officials thought that US exports were sustainable without any further subsidies, but they were mistaken. Instead, global wheat prices dropped by 50%. And so highly leveraged farmers soon found themselves falling behind on loans to the banks. And this should have been an early signal of serious troubles ahead. But again, the belief in market forces by those in high public office and their economics advisors was unshakable. They just, had no sense that things could get as bad as they would get in the 1930s. So as land prices fell, investors shifted their cash reserves from land speculation into the stock market. So you move surplus finances from one part of the economy into another, and that drove up prices for stocks far above what was justified by corporate profits and even forecasts of business activity. It was just, a frenzy of unreasonable expectations. So by the end of the 1920s, the credit-fueled speculation ran its course. The fortunate few took their profits and withdrew from the market, but this left most others to face margin calls. And it's always those who are highly leveraged who are the first to go bankrupt, go into foreclosure, lose their assets, and followed closely behind by the banks that made the loans to them. So as we know, panic selling of the stocks began on the 29th of October, 1929. And soon thereafter, a general recession developed. And because of a combination of action and inaction by the government, and not just the United States government, there's other governments were acting in their perceived self-interest, the aggregate effect was to implode the global economy. A trade war that occurred, each country trying to protect its domestic producers and its domestic markets, but it had the foreseeable fact that the global economy fell and everyone found themselves in deep straits. So here we are, 2022. Should we be doing what we're doing in the United States? The current piece of legislation just passed, doing everything we can to support domestic producers. It's a debatable subject. Every country today needs certain industries to be strong enough because of certain national interests. So yes, the United States needs a strong semiconductor industry. We need to protect raw material sources. We don't have those in the United States. Britain doesn't have them for semiconductors. There are only a couple places in the world where the raw materials necessary to produce lithium batteries exist. So what do you think is going to be the foreign policy positions of those countries like ours that are totally dependent upon these resources for the new economy, for the new green economy, for electric vehicles? I don't know what we're going to do, but if every country acts in its own self-interest, narrow self-interest in the short run, the same result as occurred in the 1930s is predictable. By 1933 in the United States, average farmland prices fell to $30 an acre. Some 52,000 farmers declared bankruptcy between 1920 and 1929. Another 38,000 farmers lost their farms during the 1930s, all the way up through 1939. So the New Deal is in effect for most of those years, and yet an additional 38,000 farmers continued to lose their farms. And a larger and larger number of banks fell insolvent and closed their doors. Now, this is where we get into a story, part of the story that may have some lessons for us going forward. Farmers everywhere were hurting. However, in one state, North Dakota, farmers who fell behind on their loans and lost their farms were allowed to remain on and farm the land as tenants. This is because their bank was the publicly owned Bank of North Dakota. It had been established in 1919. This is a picture of the bank's headquarters today. When the nation finally emerged from the Great Depression, this is a North Dakota farm in the 1940s. But anyway, when the nation finally emerged from the Great Depression and agricultural commodity prices recovered, many of the farms were sold back to their original owners under terms the farmers could afford. That was the decision made by the directors of the Public Bank of North Dakota. This did not happen when the loans were made by shareholder-owned banks or New York-based banks. They took the real estate, they took the farms, they sold them to the highest bidder, whether it was a speculator or a corporate agribusiness or whatever. So there's a model for what might have occurred. And we've had a number of farm crises in the United States, even since the Second World War. Some of you may have tuned in to the various farm aid concerts where the nation's music stars raised money to help the farmers who were in deep straits. Well, if every state had a public bank such as the Bank of North Dakota, farmers may not have had to deal with that kind of serious problem. I don't know what it's like in any other country. If any of our friends from Australia are on, or Michael, if anyone wants to comment on what's happening with farmers in your country right now, I'd be interested to hear.
Well, we seem to be in a similar trouble. It comes back to the question really of we're reluctant we're reluctant to change or to see what's obviously needed. You know, your illustration of the farmers, obviously the farms could have carried on, but they were being prevented from doing so, and it's because of dogma or bad practices that needed to change, and it happens in just about everything. You know, I mean, I mentioned the railways in here. You know, there's been some catastrophic strikes taking place in London about, you know, the whole national network is going down because of the inability to get a proper working conditions and wage reward for the function of railway of train drivers, etc. And they're very highly paid. They get about £45,000.
Well, what about farmers themselves? Are farmers experiencing revenue problems and debt problems? Are they losing farms to foreclosure?
Well, I think you know, I only speak to, you know, with Duncan Pickard. He runs a farm up in Scotland, etc., and he's always complaining about the burden of taxation, etc., and the subsidy situation. But people can become addicted to subsidies, and when you try and get rid of them, and you get.
Yeah, Duncan was a university lecturer, and he purchased a farm, and his family operates a farm in Scotland. And he's written extensively about agricultural policies in the UK. I think he wrote an article not too long ago for Land and Liberty on the situation. So I would refer those in the class to take a look at Duncan's writing on the subject. Anyone from Australia on the call?
Yeah, Scott here. Mate, Australia, probably like the rest of the world, has been hammered by natural disasters. It's had a very adverse impact. Some of our industries have had good prices over the last few years. Regulation, biodiversity, biosecurity is a large issue we have here with possible foot and mouth disease coming in from Asia. So I was an ex-banker for 38 years. I've got a family farm. We've just gone through a flood and we've lost virtually everything. So life's been 8 months ago was fantastic. Today it's back to Maslow's level of survival rather than self-actualisation. But I suppose a farmer in a lot of respects has to pay retail for all his inputs, but only gets a wholesale price when he sells his product. So at the moment, it's quite interesting and difficult. Thank you.
Is China a major purchaser of agricultural land in Australia as it is in Africa?
Yes, it has been. They're very strategic in what they have purchased, large land holdings over a period of time. We have a foreign investment review board, but obviously, like most countries, they're looking to raise capital to improve infrastructure, etc., which the Chinese are very astute, and they have obtained a lot of our water rights. They've obtained a lot of our electricity, and a lot of our very good agricultural land. So they're very astute people the way they go about their business.
So, I mean, you can hear the theme here that we have a mentality of scarcity. And when there is an acceptance that scarcity is the norm, that domestic policy tends to be strengthened to protect domestic producers, domestic industry, et cetera, et cetera, et cetera. And that's never really worked very well. In the United States in the 1930s, we had what was called the Hawley-Smoot Tariff Act. And it was thought it was going to help, stem the outflow of US dollars. What it did was generate retaliation on the part of all of the US trading partners, and only furthered the depth of the duration of the depression. So the more things change, the more they seem to stay the same, at least in terms of how our perspectives on dealing with these problems occurs. So here's 1929, and just an example of, you know, how much wealth there was, personal wealth there was in the society. Only a few analysts were really seriously looking at this level of wealth concentration as a problem. Henry George had brought it up in his writings in the 1880s, in Progress and Poverty in 1879, and even in writings before that, all the way up to the time of his death. And those who embraced Henry George's analysis continue to make these arguments, but with less and less success in terms of the policy arena in the United States. So others were looking at the same experiences and coming up with their own conclusions. And one of the persons I wanted to talk about a little bit at this point is a man named Edward Harwood. There might be a few people on this call who know the name at all. But Harwood eventually founded the American Institute for Economic Research. Today, it is very much on the conservative / libertarian side of political ideology. But the organization produces a lot of fact-based studies on what is happening in the economy. And this was Harwood's interest. He was an assistant professor of military science at MIT in the 1920s. And he had degrees in engineering and business from the Rensselaer Polytechnic Institute. And he became very much interested in economic cycles. Others at MIT then encouraged Harwood to found a nonprofit dedicated to research on cycles, and that's what he did, and it continues to exist to this day. Here's a photograph of AIER's headquarters in Massachusetts. So in his writings, and one of the books that I've read that has had some influence on my own thinking was a book he wrote titled Cause and Control of the Business Cycle. Now, Harwood was certain his research had uncovered the reasons why economies experience these repeating cycles of boom and bust. And early on, he urged his readers to be patient in their reading of his book and not jump to conclusions. Remember, he's writing this at a time when Keynesian ideas are not yet prevalent. Most economists and those at MIT would certainly have been of the neoclassical school. And here's what he said to his readers. Rio?
No, it is advisable to sound a note of warning against deserting the scientific attitude for the shortcut to the wrong answer, which so many have already followed. It may seem obvious that if a beneficent government would only monetize silver or set the printing press to work or embark on some other scheme similar in principle, all will be well. Unfortunately, depressions will never be cured so easily.
So he's dealing even with a legacy of monetary theory that you can go trace back to in the United States with William Jennings Bryan and the debate over whether gold and or silver ought to be the backing of currency. So if we monetize silver, as William Jennings Bryan wanted to do, that would take us off the quote cross of gold. It would dramatically increase the monetary supply without increasing inflation. But that was not to be the case. And so you're getting now to a decision, well, what do we do? Do we increase taxation? Do we issue bonds? Or do we simply, as he suggests, set the printing presses to work? The facts And the figures at the time to Harwood convinced him that the main problem was the rules governing or not governing the issuance of loans by the nation's banks. And as a retired banking loan officer who was always very concerned about underwriting the risk that we took and doing it effectively, I'm sensitive to the accuracy of his concern. So he says in the book,
all during the period of extreme prosperity, the banks have been making new investments at a faster rate than the growth in savings has warranted. The total of investment type asset has, therefore, steadily increased relatively to the savings justifying them. The reversal of the process is the condition called deflation.
so if you Harwood's arguing the case, think about what we've been doing since 2010, really, that we have dramatically increased the amount of money available, but has the total of investment type assets increased at the same rate. And by that, I'm really talking about capital goods. Have industries expanded their infrastructure, their capital goods, their capacity, their new technologies? Or has a lot of this money gone into natural asset speculation, or simply been poured into, again, purchasing stock back? So Harwood early on had something to say to us about what was happening in the economy, and deserved to have some of these policy ideas looked at. In an effort to tame the beast, Harwood argued that the Federal Reserve should force discipline on bank lending in order to control inflation. The banks, unfortunately, were not sufficiently disciplined themselves. After the 2008 crash, we went through this round of disciplining. We imposed stress tests on the banks, that they must meet these stress tests in order to expand their lending activity. There's the Dodd-Frank legislation that was passed. Initially seemed to have a lot of teeth in it. That's been slowly eroded away. It was eroded away mostly under Trump. Whether or not the current administration is going to strengthen that, whether the Federal Reserve is going to tighten its banking rules now that it's trying to use its powers to pull back on inflation. This is a game that they're playing that has no easy, fix to it. We're going to find out very shortly whether or not it works or not. Harwood goes on to say this:
by determining certain limits beyond which inflation will not be permitted to proceed, the Federal Reserve Bank can, by selling securities and raising the discount rate, force member banks to curtail new originations of credit based on investment type assets.
And so that if you think about it, this is exactly what the Federal Reserve is trying to instill right now. And if you listen to the news every day, no one is really sure exactly what's going to happen. Well, Harwood knew a lot, understood a lot about what was happening in the system then, but he does not go into, in his book or any of the writings that he produced for years thereafter, that he had any familiarity with economics of land markets or the impact of the private appropriation of rent on the production or distribution of wealth. And here's what's interesting about his story. Some point after 1932, he was frequently engaged by individuals who accepted Henry George's analysis of the cause of economic cycles. And gradually, as he studied the role of rent, Harwood acknowledged the destructive character of the existing tax regime. He had come at least part way to accepting the conclusions reached by George. And it will be interesting to some of you that he eventually was brought onto the board of the Henry George School of Social Science. And so some of his later articles in the 50s, early 60s dealt with the property tax and its the value of moving to a land-only property tax base. Arguments were raised at the time by those on the left that the nation's socio-political arrangements and institutions amounted to socialism for the rich and capitalism for everyone else. Those on the right argued that government intervention on private economic arrangements was the main problem. The truth, as always, is generally somewhere in the middle. There's a role for government. Adam Smith said the government's role is as the umpire, to create a fair field with no favors, to eliminate subsidies and monopolies. In the 20th, even 19th century, those who continue to write that Adam Smith was in favor of a laissez-faire economic system failed to get the true definition of what laissez-faire meant to the French physiocrats who came up with the concept. Henry George, looked at it and said, yeah, the physiocrats were right. Smith was right. There is this role for government, and that is to prevent monopolies, to prevent subsidies and privileges. And once you do that, then you've cleared the way and you can let things alone. Then the market can function. The competition will take care of things pretty well. Doesn't mean that you're not going to need government to step in for that assist in to satisfy needs that the private sector can't fulfill. There are many things the private sector cannot do efficiently on its own, that government intervention is required. Here's a chart from the late 1970s on that shows the concentrated ownership of household wealth in the United States and how it climbed back up from the 1970s. So you can see that it dipped down in the middle of the 70s, but then slowly started to climb back up. By 2007, this level of concentration was back to where it had been on the eve of the Great Depression. And from the data that I've seen, similar concentrations existed in the UK and Canada. I don't know if that's true of other countries or Australia, but I suspect that it was probably pretty similar. Here is household income. And household income in the US accelerated at a faster and faster clip, beginning with the presidency of George H. Bush. And it's many times greater than it is right in this chart. This is to 2006. So the top 0.1% of the households may now be as high as this 626 billion. I couldn't find a chart online that really gave me the current statistics, but it just keeps getting worse. I mean, that's a perspective. I believe the more concentrated it becomes, the worse that means for our economy and our society. Other people don't seem to be bothered by that level of concentration, with the idea of, well, those at the top are reinvesting their surplus income. But again, are they reinvesting it in productive activity, or are they basically investing it in rent-seeking behavior?
I'm sorry.
Yes.
Is this figure per is annum, per annum, or month? monthly or weekly income? Is this?
This
Oh,
was
it's just the
uh,
growth
growth,
amount.
yeah.
Oh, sorry.
So yeah, how the $863 billion in household income growth during the first 4 years of the Bush recovery. So I really should try to get a picture of what I think maybe I even have it. I can't remember now. Now this is showing you what has happened since the financial crash. And there's a downturn. The net worth of US households fell at least $12.9 trillion since June 9th, right after the crash. It has come back. So again, as quickly as it's fallen, it's come back. A significant portion of the household net worth associated with financial assets and equity in a residential property partially or totally disappeared. And that's because the land markets crashed. But the losses were most severe where the subprime mortgage lending was high. So if you lived in a state where the conventional mortgage market was losing out to subprime lenders, your probability of losing asset value after the 2008 crash occurred was the greatest. So that's Florida, Nevada, a few other states across the country. It took just 3 years, however, for the land market cycle to renew its upward climb. And of course, that was stimulated by the monetary infusion by the Fed and by falling interest rates on mortgage loans. So for those households who had little or no debt, who experienced no interruption in their income, their unrealized net worth began to recover as land and property values climbed and continued upward, so that they eventually exceeded the 2007 highs and have up until just now continued upward. And if you look across the United States, even the slowdown in increase isn't consistent. There are some markets that are, despite the rise in mortgage interest rates, are continuing to experience increasing median housing prices. And Ibrahima, before we started today, told me that in New York City, the median apartment rent is now $4,000 a month. Imagine, what a strain that is on most working people's income. So this chart here compares Texas with the US. And it can look at, depending upon where you live, where your line might be as against the US. So in Texas, housing prices were for a long time lower. In some states, if you're in New York, that line is probably higher. And depending upon what metropolitan area you live in, the line is going to probably be higher as well through this entire period. The role that was played by the banks and other financial institutions has had a lot of attention by both economic historians and critics of our economic institutions, and with good reason. But what occurs again and again is that bankers exhibit a strong tendency to move away from prudent lending and investment practices when stresses in the economy threaten transaction volume and their desired market share, as well as profit margins. So if you're a corporate entity, financial entity, and you're the CEO of a bank, a large bank, what you want is for Wall Street to always have a buy or hold on your stock. And so what you want to be able to do is quarter by quarter report that your profit margins are up, that your transaction volumes are steady, and that your market share is the same or improving. And you'll make a lot of adjustments in your risk analysis. You'll tell your credit people to make adjustments. This is what I was on the credit side of the house at Fannie Mae, and our marketing people were always making these arguments. Oh, you guys are, are making it too tough on us. A company like Countrywide Funding, the largest mortgage banking entity in the United States at the time, basically said to us, look, if you don't buy the crap that we're producing, we're also going to not sell you the good stuff. We're going to move everything, the good stuff and the crap, somewhere else. And so you're sitting there, well, geez, what decision do I make? Do we underprice loans that do not qualify as good risk, that they're really, these mortgage-backed securities are junk bonds? Do we give them a price break in order to keep market share? Every financial organization has this battle going on between the people who want transaction volume and market share and protect profit margins, at least nominally, and the people on the credit side who say, we can't do this. It's a disaster in the waiting. And in too many cases, the marketing side, the public relations side, the Wall Street analyst side wins. So it's always a consideration for banks and bank regulators of what is the prudent level of risk-based capital to hold. And that's what these stress tests are now trying to determine, whether the banks are in a good position. Do they have enough financial capital in reserve to weather the next storm? And how severe will that storm be? What level of delinquencies will occur? And what are your counterparty risks? I mean, one of the things that financial institutions do is try to sell off some of the risk. So in every bond that's issued, every mortgage-backed security, all of the derivatives, the idea is pass on as much of the risk to other players. So if something goes bad, we're only going to be hit with a small portion of the total loss. And in 2008, that gamble didn't pay off because the underwriting was so poor and the risks were so great. Now, this just shows you that the 2007 crash wasn't unique. This is just the bank failures that occurred from 29 to 33. During the so-called Roaring '20s, an average of 70 banks failed each year. Doesn't sound like a lot, but what if it's the only bank in your county? If you're in an agricultural or rural community, there might only be one or two banks. Many were small rural banks. They served these troubled agricultural communities. Falling crop prices drove land prices down by 30 to 40% in the 1920s. And as a result, a growing number of farmers defaulted. This situation actually worsened during the 1930s, and the bank failures escalated. So during the first 10 months of 1930, the number increased to 750. By the end of the decade, a total of 9,000 banks closed their doors. Depositors lost $140 billion. That's equivalent to $2.8 trillion in today's money. And a response had to be found. And when Franklin Roosevelt was elected, he and his economic team came up with some ideas. What is not generally understood or admitted, actually, is that some of this stuff was in development by Herbert Hoover. Hoover was not a fool. He believed in market forces, but he recognized that something had to be done. And so, he began to create a blueprint. He wanted to share this blueprint with Franklin Roosevelt once the election occurred, but Roosevelt did not want to talk to Hoover. He wanted to wait until he got into office before he considered any measures that should be adopted. Well, we'll end with this. In 1933, his first year in office, they approved the Federal Deposit Insurance Corporation's creation. Now, this offered surviving banks depositor insurance beginning in 1934. So with Federal Deposit Insurance, this ended the widespread bank failures. It ended the runs on the banks because people now knew that there was a federal entity that was going to guarantee that when they wanted to go to the bank and take out their $100 in savings, it would be there. And so FDIC in the United States ended bank failures for the major part until the stagflation of the late 1970s. And what hit the banks then was new competition from the new money market mutual funds. And they first hit the US savings and loan industry hard and brought the S&L industry on the brink of collapse. Mergers and many bank closings followed. I was transferred at Fannie Mae for a time to work to basically do analysis on the portfolio of loans held by the savings and loan industry and bid on them. We basically bought a lot of their assets, and based on, when you do this analysis, you have to look at not only the health of the loan or people paying it, but what's the yield. So if the loans have a weighted average yield, let's say of 7%, and the current market is at 12, then as with any bond, you're going to bid some discounted amount of value. So with a bank that had $500 million in loans, maybe the current market value of those loans was $350 million. And so now you have $150 million of loss that has to be recorded. And it's not going to be recorded by the insolvent S&L. It's going to be paid for by taxpayers. So that's what happened in the late 80s, early 90s. And again, just thinking ahead, the question is, are the stress tests now being imposed on banks appropriate? Do they have sufficient risk-based capital? Is their underwriting criteria sufficiently improved so that they have priced for the risk that they've taken on? And as we go into this current recessionary downturn, will the banks be able to work out loans that become delinquent? What will they do with the real estate that they might take into portfolio until they can market it? And how will that affect the property markets going forward? So we have a lot to monitor to determine how deep and how long this current recessionary downturn will be, and whether or not it will start to come back up before we hit the maximum stress that I suggest we're going to hit in 2026. So with that, I will stop, and I will hang around for any questions or comments as long as you'd like to do that.
Thank you so much, Ed, for the lecture. I had this question I wanted to ask about just the recent spike in those property prices. is it the case that cannot be argued that it's not the value went up, but the other side of the fiat currency lost its value tremendously because of the past few years of all these crazy spending, one of the from the COVID and the likes. And I've once heard about an argument that in the past few years, the feds have printed more money than they have in the entire recordable history of United States
Yeah.
finance.
Yeah, I mean, the nominal value of financial and other assets worldwide is almost inestimable. And just, you know, everyone pointed to the debacle created by derivatives and how that impacted the financial institutions when the value of derivatives collapsed. Well, the derivatives market is as strong or stronger than it was in 2007. And a lot of this is what's called over-the-counter transactions. So we don't know. We don't know how much money is being put into the higher risk parts of economies around the world. But the standard definition by economists of inflation is too much money chasing too few goods. There's certainly a lot of money chasing what goods are out there. But investors include financial assets as a significant part of the goods. Whereas, you know, a more rational determination, in my view, of what the real economy looks like would be the aggregate value of depreciated value of capital goods. I mean, that at least we can get from accountants, you know, and everyone who owns an asset, tangible assets, has it on the books at the acquisition cost less depreciation. And then when let's say you have a factory building and you modernize it, it's easy to come up with a reappraisal of the value of that property, you know, based on how much money is spent and what its potential resale might be. If we could get that aggregate number, then we would have I think, a better estimate year to year of what's happening to the real economy. But right now we don't have it. We just have GDP and how much money is being spent on everything that's being spent on.
Yes, that's the difficulty. Yeah. Thank you for your insights.
Charlie.
Yeah, good day, Edward. How are you, mate? Can you hear me?
I can hear you. Go ahead.
Yeah, cool. No, just a thought about inflation down in Australia. Just want to bring up a situation whereas because our states are sort of run sovereignly, they're independent. And for example, Western Australia has government policy there where they have to keep a certain amount of supply of, let's say, you know, liquid natural gas and coal for energy production to supply their locals. So their costs are relatively low to what's sort of happening in the east, where, you know, our prices are skyrocketing because most of it goes abroad, gets exported, and we're forced to pay higher prices. And again, you know, is it that simple of a solution where they can implement that to lower inflation in that sector for us? You know, and why isn't it happening, you know, countrywide? Again, yeah, what your opinion? You know, and is that sort of applicable to anything? You know, can government lower taxes on imports to incentivize people to bring more stuff here that we're lacking, and sort of control inflation that way, rather than just a Reserve Bank dialing their knobs for, you know, to increase rates and quantitative tightening?
Well, my people need food, shelter, medical care, and education most of all. My view, given the way the global markets work, is the best use of public money by government, other than for physical infrastructure, is to subsidize the cost of food to people and subsidize the cost of housing to people. That to me is what governments ought to be doing to minimize the impact of inflation on those who do not have investment portfolios. I've given you a little bit of statistics on the United States, but the median net worth of retirees in the United States, net worth, this isn't income, is $172,000. But that's not enjoyed. That means half have less than that. And if you're a renter in the United States, your median net worth is under $10,000. Now, if you're paying $4,000 a month for an apartment in New York City, you're basically homeless after 2 months. If I was to say, first of all, it's a terrible thing to say, but Australians probably should not be producing coal for the environment. But if you're going to produce coal, better that you sell it to China and let the Chinese burn it. You take the revenue from selling the coal to China, invest it in solar panels and wind turbines. And then when the coal runs out, you have sustainable energy at much lower cost. I don't want to be quoted on that because I don't want to be said that I'm encouraging selling, polluting fossil fuels. But those are the natural resources that are available. And again, if you have tar sands, if you have oil, if government is going to encourage its production, then the best thing in my view is sell it somewhere else and use the revenue to subsidize sustainable energy.
But until we get to that point, obviously a lot of people are going to feel the pain on that short, to however long it takes to get to be able to have sustainable renewable energy for everyone, and it could probably take years and years.
Well, that's okay. So sign on to the universal basic income idea as one way to do it, but the universal basic income will help people in the lower quarter or a third of the household incomes only if they have housing expenses that are stable. So whether you can do it any number of ways in any society, but communities have to put money into affordable housing, into permanent affordable housing. There are any number of ideas that have limited or wide value. Community land trusts are one way to do it, and then you have deed restricted housing. So community funds the housing in part. It's sold to people with incomes no greater than some percent of area median income, and then it's deed restricted. You can't sell that property in the future to any household that has an income above the same area median income. There are all sorts of ways, but encourage communities to put vacant lots to use growing food. In the 1930s, the cities all across the world did this. It was a very successful program in cities like Philadelphia in the United States and Detroit. They had community gardens, and there are community gardens now in some of the more distressed neighborhoods in our major cities in the United States, where finally, because there's no or very few supermarkets in that community bringing in fresh vegetables, finally people said enough is enough, we're going to grow our own. And so putting vacant land to use community-owned vacant land to use growing food crops provides fresh food for people that they don't have access to otherwise, and an income and a source of work for people who might be unemployed. So all these things that can be done to mitigate, the seriousness of the problem. But in the end, we have to deal with the systemic causes. And so we need solutions that are systemic. And as I go through this course, I'll identify more, but I think that, Henry George's solution is right here up at the top. MMT's analysis has to be considered. Public banking has to be considered. Tax reform has to be considered. All of this has to work as and Roosevelt, as president of the United States, would have agreed, we need to try all kinds of things, measure the results, and if it's working, do more of it.
No, thank you.
Many of you have been quiet. Have anything you'd like to ask or to contribute? Reactions, comments? This is an open forum. It's an opportunity for you to speak your mind. Even tell me I don't know what I'm talking about, and I should read somebody else's book.
I'd like to say one thing, Ed. It's gone a bit beyond what I was going to ask actually, but I said I was going to ask, when you look at any insurance policy or anything else, there's a little phrase that says in the small print that says the asset can go up or can go down, and it seems to be appropriate that assets can go up and down, and the idea of an 18-year cycle is an example of the assets going up and down, because that's the only, that's almost a universal.
Well, what, if you sat down with a financial advisor, they're going to tell you, because of that, because they understand that the economy goes through cycles and asset values go through cycles, that you don't want to be pulling. I mean, if you really want to spend your life tracking investments, you can be a timer. You can do market timing, and you can probably be very successful. You may be able to beat the market on a regular basis. But if you're not prepared to do that kind of analysis, and you're paying someone else to do it for you, their advice generally, because they're conventional in their analysis, is stay in your investments long term. They'll bear out. If you invest wisely in companies that have produced over time, they're going to experience downturns, but eventually they'll recover. So everyone, I'll say, diversify and stay in the market long term. Just let the money work. Don't panic when things go down. Now that's fine if you're not dependent upon income generated from assets to pay your bills.
Yeah.
So
it's a risky policy, isn't it? Well, as it were, that all things will be well, but too many people seem to have to be sacrificed in this law of the jungle, really, which is a bit, it is the natural law that finally has its say, as it were. If you go on as you're doing, these cycles perpetuate, etc. And I find that rather depressing, really. I think, the human race must get itself organized a little bit and do things intelligently. Why we don't seem to do this is a poor, is a poor example of the, human society and etc. that they never seem to want to get it right somehow.
Yeah, as I mentioned earlier, I'm enjoying reading Heather Remoff's book. It's because I haven't thought about human behavior in the way that she suggests we could benefit by that kind of an analysis, by a Darwinian analysis modified. But it's a book with a lot of rich reward for those who read it. And I mean, there are others. As I'm reading Heather's book, I'm thinking about another book. The philosopher Mortimer Adler wrote a book titled "The Difference of Man and the Difference It Makes." And and what is so different about us? It's our capacity to think, our capacity to plan, to contemplate the results of our actions before we act. But it's not perfect. We demonstrate that all the time by contemplating what our actions are going to, what the outcome of our actions are going to be. Then we act, and we're totally surprised that what we thought was going to happen didn't happen.
Right, I suppose.
Well, it's about 20 after 8. I think Ibrahima would love to end the class so that he can go home and take the rest of the night off. I'll take one last comment or question, and then we'll call it a night. Okay. Well, Gail. Okay. You're mute. You're still muted, Gail.
Sorry, I would like the title of Heather's book again. I missed it.
Oh, the title of the book is what does sex have to do with it? It's
Okay,
published in England by Shepherd Walworn Publishers.
and it's an evolutionary analysis, did you say?
Yes, yes.
Okay.
All right, everyone. Thanks for joining me, and hope to see you all next week for the next part of this lecture series. Good night.
Thanks, Ted. Well done.
Thank
Cheers.
you.
Thank you.
Good night.